So again, thanks for having me today. As Kevin mentioned, I'm the tax director at Chrysler Miller. I've been with the firm for probably close to 20 years now. I operate in different industries. My specialty is with construction contractors, but I do spend a lot of time in other areas with manufacturing distributors. So today I'm going to walk through the various tax credits that are out there with the pandemic, going back to when the CARES Act first came out last year. The reason why we were covering this today, because it's important, because we're finding a lot of businesses are sort of fatigued right now, and there's so many opportunities out there with these credits that people are not taking advantage of it because I think of the fatigue and there's just so much information out there. So we're going to walk through high level, not getting into great detail, but high level of sort of what's out there for a lot of businesses that should they should be taken advantage of. And again, if there's any questions as we go through this, I'll try to pause throughout the presentation to see if we can address any questions when the time permits. So I always like to kind of throw it out there that this presentation is as of July 27th of 2021. Again, tax law is constantly changing with rules and regulations and different interpretations that come out at a later date. Anytime you're trying to take tax advice and use it for your business, you just want to make sure you consult with a tax advisor. So that's my disclaimer on today's presentation today. So what we're going to cover today, 6 areas. I'm going to spend some time with the employee retention credit, take a little bit of a deeper dive into other areas, and then we're going to go into some other credit programs. I want to focus on the WOTC, Worker Opportunity Tax Credit, because that's getting a lot of play right now out there in the marketplace. So we're going to cover that a little bit as well too. So employee retention credit, I'm sure many of you have heard about this, and this first came out under the CARES Act back last year in March of 2020, and a lot of businesses, mid-sized and small businesses, had a choice back then to either take the Paycheck Protection Loan or the employee retention credit. And it just made more sense for smaller and mid-sized businesses to go with the PPP loan at the time. So the employee retention credit was kind of left off the table because they had to take one or the other. The law did change in this area back in December under President Trump's watch, his last tax act that he passed in December of 2020, where the employee retention credit was basically now allowed for businesses that took the PPP loan. So it did expand and open up the opportunities for businesses to take advantage of it retroactively back to March of 2020, and then also prospectively going forward to 2021 with some enhancements. So think about this: the government has given businesses cash to fund their payroll, and this is a big deal for many businesses. So looking back in 2020. Your business could potentially apply for credit, which is 50% of wages paid to your employees up to a $10,000 salary cap. So to kind of quantify that, that could be $5,000 for each employee that you're paying them during the calendar year of 2020. The enhancement happened in 2021, where it's 70% of wages paid up to a $10,000 salary cap per quarter. That's a big deal compared to per year in 2020. So if you're eligible for each quarter for this credit in 2021, it's going to multiply. And I've seen some businesses where the credit for each quarter in 2021 could be 7 figures, $1 million or more, which is a huge opportunity that we're seeing out there. And the thing about this is a lot of people have looked at this and say, well, is this going to be like the PPP loan where do we have to qualify? Do we have to make certifications that my business will qualify for it? And the answer is not really. It's simple. It's a simple test. If you had to decline your gross receipts, or if your business is partially or fully shut down, then you're going to qualify for this credit. And it's as simple as going through the analysis of looking at your payroll, who you paid during that quarter, and coming up with a percentage of their wages. And it's as easy as that. And then you recognize that and you report that on the payroll tax return, which is the 941. And that's all you do. It's a very simple calculation. It's much simpler than the PPP loan. And I think a lot of people have been sort of scared off because they were afraid that here's another program that the government's putting out there that they're going to sort of like change the rules on us and require us to do a lot of paperwork at the tail end. And that's not the case here. The credit, as I mentioned, from March 12th, 2020 up until January 1st of 2022. So again, we're still in that window of opportunity in 2021. If you haven't taken advantage of this credit yet, looking back for 2020 tax year, you can still take advantage of that because this credit is available on a look back provision. So you have 3 years to go back and amend your 941 payroll tax returns to claim this credit. So the opportunity that does exist for this as well too. And it applies for for-profit as well as tax-exempt entities like 501c3 organizations. So it applies to businesses all across the spectrum. So what I always like to start off with high level when I'm working with my clients in this area is I like to start off by asking 6 questions. And I'll walk through these with you quickly. The first question is, did your business experience a 50% reduction in gross receipts in any quarter in 2020 compared to the same quarter in 19? And if the answer is yes to that, then you're going to have a qualifying event where the wages you paid during those quarters could qualify for the credit in 2020. Did your business was required to be partially fully shut down from March 12th up until the present time, even until the end of this year? And where we see a lot, we saw a lot of this was actually back in March of 2020. If you notice, Pennsylvania, when they came out with their shutdown orders, very specific on businesses that were required to shut down. So they had a list of very specific industries that were required to close their businesses. So we spent a lot of time looking back at that list to see if these businesses were on that list there, because you have to have orders from the state or local government to be shut down. So we saw a lot of this, obviously, with the restaurant and hospitality businesses. But contractors was a big area too, because contractors are required to shut down their businesses. We saw with some manufacturers, healthcare, outpatient surgery centers are required to not do any elective surgeries. So there was a lot of opportunities across different industries with this. So if you're looking back and haven't taken a credit yet, and you think you fall into this area, you should probably look into this because it's a good opportunity there. Number 3 is how many full-time employees did your business have in 19? That matters. If you had less than 100 employees, then the credit applies to wages paid to all your employees during the time your business was shut down, or if you had the wage reduction or the sales reduction. If you're at over 100 employees during the 2020 calendar year, then it's just the credit applies to employees that you paid that weren't performing services. So think of it as folks that you had furloughed, but you still carried your health insurance. Even though you weren't paying their wages, the health insurance costs would be included in a wage-based calculation. In 2021, they changed that to where they increased the threshold of 500 employees. So under 500 employees, it's for any wages you paid that qualifies for the credit. And number 4, did your business experience a 20% reduction in the gross receipts in fourth quarter of 2020 compared to fourth quarter of 2019? And the reason why I bring this up is because if you're looking at seeing if you qualify for the credit in 2020 off the old rules, you're looking for a 50% reduction in your gross receipts. So even though if you don't qualify for that, if your fourth quarter of 2020 has a 20% reduction, that allows you to have the first quarter of 2021 qualify for the credit. And the reason why I mention that is because when the law was enhanced in December of 2020 to extend this, they put a provision in there that said that you can look back to a prior quarter to see if you had a reduction in your gross receipts. And that reduction, instead of being 50%, now it's 20%. So we had a lot of businesses, even though their first quarter was a strong first quarter compared to that same quarter in 19, qualifying for the credit because of this look back provision in the fourth quarter. Did your business experience 20% reduction in gross receipts in the first quarter 2021 compared to 19? And then number 6 is the same thing for second, third, or fourth quarter of 2021 compared to these same quarters in 2019. So what you're looking for there is obviously you're looking at first quarter gross receipts. You're comparing that to that same quarter in 19. 19 is always going to be your base year because that's a normalized year. And you're looking for that 20% reduction. So again, this is something where easy to do. All you're doing is running a report, looking at your gross receipts based on your tax method of accounting to determine if you have this reduction in gross receipts, to determine if you qualify. Quick example here. As I mentioned to you, if you're doing analysis for the gross receipts test, determine if you have this credit opportunity. If I'm going to look at my first quarter of 2021, and let's say it's $400,000 as an example, and I compare that to my 19 gross receipts, well, that's a difference of 72%. And said it a different way, I have a 20% reduction in my gross receipts in that example there. So my first quarter would qualify for the credit, and then I would go through my analysis, look at each employee, and I would take 70% of those wages up to a $10,000 salary cap for each employee to determine what the credit's going to be. For second quarter, if I look at that in this example, 600,000 is my second quarter gross receipts in 2021 versus 2019 is 555,000. So if you notice there, I did not have a reduction in my gross receipts, but I still qualify because I'm using that look back provision I just mentioned in order to qualify. So in this example here, this business is able to qualify for 2 quarters for the ERC credit. So that's a huge opportunity there that we're seeing businesses taking advantage of here. And again, we're seeing some of them in the 7 figures for each quarter. Another example too, using the same figures, but just kind of changing it around a little bit. If my fourth quarter of 2020 was 400,000 compared to my 19 gross receipts of 555,000, again, I had more than a 20% reduction in my gross. It's not more than 50%. So for the 2020 credit, I don't qualify. But using this look back provision, I will qualify for the credit for first quarter of 2021. And even though my first quarter of 2021, I did not get my 20% reduction, I still qualify for quarter 1 because of the look back provision there. So we see a lot of businesses not really paying attention to this. And this is a big area where we're seeing people qualify, because you think about it, a lot of businesses were sort of, we had that spike back in the fourth quarter of last year, which saw a lot of businesses shut down or even kind of reduced their shipments, what have you, with other business you're in. So good opportunity there for that. I just want to point out to you a couple of things to consider. You can take these, the credit, if you also have the PPP loan. The thing is, you just can't take it on the same wages. So you have to try to optimize both programs. So for businesses that qualify in 2021, but also got the PPP loan round 2, you just have to go through and just kind of optimize the program where you're kind of looking at it and saying, can I use some non-payroll costs for the PPP loan so I can free up these wages for the ERC credit. It's better to take the PPP loan because it's tax-free money. You do have to pay income tax on the employee retention credit, but if you can get both programs and maximize both, that's the goal there. As I mentioned, health insurance costs would be included in the calculation. So we see this a lot of times where if you're going to go back and look at 2020 and say, look, my business was shut down for a period of time before I got my PPP loan, and I had over 100 employees, but I had people furloughed. You can use those health insurance costs to be included in the wage calculation for the credit. If you're taking the R&D credit, just remember the RC credit would reduce the R&D credit for purposes of that. So there's some interactions with some other credit programs, and the way you report the credit is, as I mentioned to you, it's on the payroll tax 941. There's a special form 7200 which you can apply for ahead of time before the 941 is due to get an advance credit money back from the government in a quick way where you fax it over. And again, if this is something where you are learning about this now and the prior credits, prior quarters qualify, you can go back and file an amended 941. You have up to 3 years to take advantage of that. So I'm going to pause for a minute just to see if anyone has any questions on the ERC before I move on. And I take it with silence, we're good to move on.
Yeah, I think that's good. Well, and we're keeping an eye out. If something comes up, I'll let you know.
No problem. And again, if there's any questions that come up later on this topic, feel free to kind of put in the chat box. Moving on to the next area, the tax credits, FFCRA credits. This is an area where this came out. This was a tax act, or a legislative act that came out St. Patty's Day of last year in 2020 before the CARES Act. And this was a mandatory requirement where businesses that had under 500 employees were required to pay their employees if they're out on sick leave related to COVID reasons, or if their child was in daycare and the daycare was closed down and they were required to stay at home and watch them because of the pandemic. So these are requirements by DOL that you had to make payments for these employees, and the government was simply going to reimburse businesses back through a payroll tax credit. I bring this up because I'm sure many businesses on the call here today are aware of it. I'm still seeing businesses that are not aware of this reimbursement provision of getting this credit back. So just be aware of that. You can go back and amend on the 941 to get this money back. This credit obviously was in place. The mandatory provisions were in place up until December 31st of 2020. And areas where it's required to make these payments in order to get the credit, as I mentioned to you, if you're required to be, your employee was out because of COVID reasons, they had COVID, or they're required to quarantine, or they were taking care of someone that had COVID, would qualify for the credit. And it's usually $515 per day up to 10 days was the max that you're required to pay. And then on top of that, you would get a credit to get reimbursed for making those payments. For childcare, 5 and 6, you're required to pay, I think it was $200 per day up to 10 weeks, which could be a max of $10,000, I believe. And again, that's again a credit up until December 31st of 2020. So just keep that in mind for businesses that were in that situation. Documentation is very important, so make sure there's a documentation process that you are documenting the reasons why the employee was out, so you have that for the files in case you ever get audited by the IRS. In 2021, they did enhance this. So under President Trump in December of 2020, this was extended, but it was extended beginning January 1st of 2021 on a voluntary basis. It wasn't mandatory anymore. So companies had a choice if they wanted to continue to make these payments or not through September 30th of 2021. So they could still get the credit. The thing of it is, though, there was that 10-day window, as I mentioned to you. So if you paid up to 10 days, you're required to pay up to 10 days for someone to be out. If you went beyond the 10 days, you're not required to do that anymore. Starting on April 1st of 2021, that 10-day limit was reset again for purposes of this credit. And also, too, they did expand the reasons why you wouldn't pay this in order to get reimbursed for the credit. So they included people that are out because of getting the COVID test, COVID vaccines, or maybe they were suffering for some type of illness related to getting the vaccine. So keep that in mind, that this is extended until September 30th on a voluntary basis, just for the 2021 year. So opportunities there. If you did not take advantage of the credit, it's still there for you.
Carla, there was one question on the tax credit, ERTC. Would that have any impact on someone's Social Security benefit calculations if you took the credit?
I probably need to get a little bit more specific on that, but the ERTC credit is really just a business credit, so it would not impact anyone's Social Security benefits there, not at all, because it's cash that the business is getting. So I'm not sure if that answers the person's question or not.
I think so. But if someone else comes in, I'll let you know.
Yep.
So.
The other area that, moving on to the next credit program, the Worker Opportunity Tax Credit, and we refer to it more in lines of the WOTC credit for short. And this is a credit that's been out there for many years, and many businesses had the opportunity to take advantage of this. And it really, what it is, it's a credit where if you're hiring from a specific targeted population within the workforce, which I'll get it to in the next slide what the targeted workforce is, then you're eligible for a credit. And the credit could be up to $2,400 per employee. And again, it's based on a scale of how long these people were employed with you. So if these folks were employed for more than 400 hours, then the calculation is 40% of wages up to $6,000, which equates to $2,400. Certain targeted populations in this credit will get more for it, but the majority get $2,400 per employee. Why this is becoming so popular now, one of the areas the populating targeted group is for those unemployed individuals that were unemployed for more than 27 consecutive weeks and received some type of unemployment compensation during that period of time. Sounds familiar, right? Because we have a lot of folks that were out of work in the beginning of COVID. I think what happened was with the long-term unemployment benefits being extended and enhanced, it sort of created a behavioral thing where many people were kind of staying at home. So there's about 3.8 million workers that could fall into this category of long-term unemployed. And with Pennsylvania, they're looking to, right now we're still in the extended unemployment. I think it's due to run out in September, and we could have more people entering the workforce again. So this is an opportunity where you can simply take this as a credit if you're hiring these people that were in this situation here. Where we see a lot of this in industries is the hospitality, restaurant, healthcare, construction. You do see a lot of that, warehousing, where the workforce is lower wages and high turnover. There are definitely some opportunities here with the worker opportunity tax credit. As I mentioned to you, there's 10 areas that have sort of been identified. And when we talk about tax credits are really like a behavioral thing that the IRS and Congress does. They channel a lot of behavioral things through the tax code. So this is an area where they're trying to get businesses to sort of be selective on who they hire and get them to get compensated for it. So again, as I mentioned, I highlighted number 8 is qualified long-term unemployment recipients, as I just mentioned. That's a big category right now if your businesses are looking to hire. Some other categories I mentioned here, qualified veterans. That's one category that would get more of a richer benefit than I mentioned to you, where the credit could be a little bit more than just the $2,400. And there's some other ones too that, as I mentioned on here, that are kind of on par with the $2,400. The one thing why people sort of shy away from this is it is a process. There is something where you need to kind of have a process down in order to calculate the credit. The one thing is when you hire someone, there's a process where you have to actually have them fill out some paperwork in order to identify that they do qualify for one of these categories. You have to submit it to the state to get certified, and then the state sends you back a certificate that you need for your files in order to claim the credit. This all has to be done within 28 days of when the worker is onboarded. Anything beyond the 28 days is going to be disallowed. So it's pretty strict requirements there. So a lot of businesses, kind of shy away from it because of administrative functions. But I do find that businesses that sort of make the investment up front and create a streamlined process, it's a win-win situation going forward, because it's a process where it gets incorporated to the onboarding process when someone is hired. There are firms out there that would support this process as well too, where they would assist you with filing the paperwork and claiming the credit and kind of passing it along to the tax preparers. So there are companies out there that will do this for you. Some payroll companies do handle this, like Paychex and ADP. So just keep that in mind too, that this is a good opportunity to take a look at. If you looked at it before and you sort of shied away from it, I think it's a good time to revisit it, just because of the rich benefits that are out there and some of the opportunities with the unemployed them coming back in the workforce again. And as I mentioned on the slide here, certain employees don't qualify. Anyone that's kind of related to the owners are not going to qualify for this credit. So moving on to the next credit program. This came out, the COBRA Premium Assistant Credit. This came out under President Joe Biden back in March of 2021 with his pandemic relief package. And this was a credit, which I'm going to just touch on at a high level, but this credit was really available for companies that were paying COBRA coverage, required to include COBRA coverage for individuals, employees that were involuntarily let go, terminated, or their hours were voluntarily or involuntarily reduced. So if someone is paying COBRA coverage from April 1st up until 9/31, then companies could get reimbursed for that through a payroll tax credit. So just keep that in mind. The rules are a little bit complex in this area, but you just want to keep in mind, if you have anyone in that situation, that you want to kind of spend some time to take a look at those rules to see if you are eligible for this payroll tax credit to get reimbursed. Moving on, an area, this is not really a tax credit, it can be, but I feel like this is an area that's definitely growing a lot. And this is called negotiated state and local incentives. And these incentives could be anywhere between cash grants, tax credits, and these are areas where you would negotiate with the state, local governments in order to get enhanced benefits. If you have certain types of triggering events, like if your company is looking to expand their business into a new market, they're looking to maybe build a new facility and maybe close down an existing one, or looking to maybe expand their CapEx over the next 5 years. Maybe they have a new product design that they're looking to implement, and it's going to cost millions of dollars of CapEx equipment and building to do that. If you're in any of those categories, this is an area that you want to pay close attention to, because you can approach these state and local governments to negotiate with them to get better incentives than what's out there currently under the statute. So, as I mentioned, what these are negotiated incentives. So it's cash or cash-like assistance provided on a discretionary basis. And really the reason why this is happening is really the government, state and local, wants to attract and retain businesses. And obviously businesses want to sort of help get reimbursed for some of the investments they're making in the community, and also to employ people in that community as well too. So it's a win-win situation if you look at it from that way. And there's a lot of state and local governments that provide this type of assistance that's out there. You just got to know what you're doing, how to negotiate, and know timing is key when you're doing this. Timing when to bring this up and negotiate. Oftentimes, if you're looking to expand, let's assume, for example, you have your facility that you have outgrown, you're looking to maybe buy land and build a new facility in a different location. You probably want to start this negotiation process before any deed has been signed or any sort of building or land has been purchased, because then you start to lose leverage with the state and local governments. So this is something where your overall strategy, long-term strategy of the business, you want to sort of make sure that you're aware of these incentives and sort of incorporate that in the process. And the timing is key of when you want to start to negotiate and bring that up. 3 areas where I just want to highlight what these incentives are. There's incentives that are statutory, and that's by right, so it's already built into the law. So for example, Pennsylvania has a PA manufacturing tax credit. That's already in law, and anyone can get it as long as you qualify. So if you expand your payroll by $1 million in 1 year because you move to a certain area, you can get a credit up to 5% of the increased payroll. So that's considered something that's statutory. It's already in the law. Then you have statutory, but it's negotiated. So it's in the law, but you can negotiate instead of maybe 5%. Maybe you want to negotiate, maybe it's 10% of payroll to get the credit. So you can negotiate what's already in there to get a better return or better rate for that. And then what we're really talking about here is discretionary incentives. So something that's not in the law, but it's something where you approach the state and local government and you say, hey, look, we're thinking about moving into your town. We think we're going to create 150 new jobs. We think it's going to be great for the community. Can you help us with that? Where we might need some grants to help train our folks. Maybe you can help pay for some more for facilities. Maybe give us a break on a utility rate reduction. Maybe some property tax abatements. So that's where you would negotiate with the state and local, and you'd be surprised some of the outcomes that we've seen. We just worked with a company recently where they were looking to expand their business because they're growing, and they approached the state and local government ahead of time before anything was purchased. They were able to get about $500,000 of cash grants in order to make this move into this specific township in Pennsylvania. So this is something where, we think about like Amazon and Google, they have folks on payroll that can do this on a day-to-day basis and are always negotiating, and as they're looking to kind of build and increase their infrastructure throughout the United States. But this is also available for small, mid-sized businesses. You just have to, again, know the process, know the timing when you want to do it. And I think this is something where it's easily obtainable out there. So as I mentioned, to wrap up on this area, triggering events, as I mentioned earlier as I started this presentation on this subject, market entry. If you're looking to, let's say you're on the East Coast and you want to expand your business down to the South, that's a triggering event. Looking to relocate or consolidate your business, that's a triggering event where you want to start to look at any opportunities. Expansion or routine CapEx. We always like to say, if you're thinking you're going to spend at least $5 million or more in CapEx over the next 5 years, you might want to consider a plan to see if the state's willing to help, or the local government's willing to help you with that CapEx investment through these incentives. So Kevin, do you have any questions so far before we move on?
Yeah, and I think we're gonna have to wrap it up here, Carlo, but if there's more, we can always have you come back some more. But thank you, this has been very informative. Did have 2 questions. I think they related to the WOTC. The first is, if you had furloughed an employee who met that 27-week requirement and you rehired them, can you claim the credit for that person?
It depends if they were collecting unemployment. So I think that's the key, is they have to be unemployed and collecting unemployment compensation. So yeah. I don't think that would qualify there.
Well, no, usually they are collecting unemployment. You're saying that would not qualify?
No, as long as they're collecting unemployment, then that would qualify.
Yeah, typically when the company's furloughed, then they're collecting unemployment.
Yep.
Okay. And then the other question was, someone said, what sort of screening or proof can an employer require post-hire to determine if someone's eligible for that WOTC credit?
It's a good question. I don't know the exact answer to that, but I do know there's a form that you have to fill out, and you're kind of going off there's sometimes with the unemployment though. I do know there's a form you get from the state that the state gives the employee that says that they're unemployed, and that's proof that they would qualify for that category there. Okay.
And somebody asked if there, and I didn't know if it was all these, what other resources are out there to help someone kind of guide them through the, if they want to really look in more detail in what the couple of things you provided. Is there any good summary resources, or where would you suggest people look?
For the employee retention credit, there's a lot of firms out there that put out white papers in this area that you can kind of Google and find information on. The IRS website does have a section for these specific programs, like the employee retention credit. There's a FAQ that they have. There's like 90 questions that you can kind of go through that kind of goes through in more detail some of this information. So that's a great resource that's out there if you wanted to take a look at that.
Okay, and I'm assuming somebody can speak to their accountant as well. And if they're not sure about that, I know Chrysler's been advising a lot of companies on a kind of consult basis on some of these pandemic-related issues.
Yeah, we always recommend that anytime you're looking to take advantage of these credits, you talk to your tax advisors on this, just because the rules are so complex. And we were just seeing on the ERC credit, we've seen companies try to do it on their own, and they're misinterpreting the rules and maybe taking credits where they really shouldn't. So you got to be really careful with that.
Yeah. All right, Carla, thank you again. That was great. A lot of information provided. So hopefully that was helpful. And we're going to turn it over to Amy at this point. Thanks.
Great, thank you.